Jeff Bezos and Elon Musk, two of the richest people on Earth, have paid zero federal income tax in certain years. How is that possible, and what can you learn from it? Today, we're breaking down the legal strategies the wealthy use to minimize taxes, and how you can start thinking like they do no matter your income. The tax system, as it stands, is fundamentally designed to reward owners and investors. It's structured to incentivize wealth creation through ownership, not just people with high salaries. The reality is that simply earning a substantial income isn't enough to unlock the full potential of wealth accumulation. Earned income, your paycheck, is taxed at the highest rates, often significantly impacting your take-home pay. And the more you make through traditional employment, the more you pay in taxes, pushing you into higher tax brackets. But investment income, like capital gains and dividends, is taxed at much lower rates, a strategic advantage for those who invest. In some cases, it's taxed as low as 0%, offering a substantial tax benefit. The wealthy understand this fundamental principle and focus on making money from investments, leveraging the tax advantages. They prioritize building passive income streams, not just relying on the income from working a job. That's precisely why their effective tax rates, the actual percentage of their total income paid in taxes, are often significantly lower than those of high-earning employees who primarily rely on W-2 income. The lesson? It's not just about how much you make, the gross amount of your income, but how you make it that truly matters when it comes to minimizing your tax burden. If you want to pay less tax and retain more of your wealth, start thinking like an owner and strategically structure your income streams to take advantage of the tax benefits available to investors and business owners. Wealthy people don't just earn big salaries. They build wealth through assets that grow over time. When you own stocks or real estate, you don't pay tax on the gains until you sell. This lets your investments grow and compound, tax-deferred, for years or even decades. When they finally sell, they pay lower long-term capital gains rates. Many entrepreneurs take small salaries and focus on growing their company's value, cashing in later at lower tax rates. Deferring taxes and letting investments compound is a cornerstone of building real wealth. The rich play the long game, so should you. Real estate is a favorite investment vehicle of the wealthy, and there's a very good reason for that. It's not just about appreciation or rental income, it's about something far more strategic: depreciation. This is where the magic truly happens. The IRS, in its own way, lets you deduct a portion of your property's value each year, as if it's slowly disappearing even though it's still standing strong. This is a non-cash expense, meaning you're not actually spending that money out of pocket. It's a paper loss, but it has very real tax benefits. This paper loss can significantly offset your rental income, reducing your tax liability. In some cases, it can even make it look like you made no money at all on paper, despite the fact that money is flowing in. This is all happening even if you have positive cash flow, meaning more money is coming in than going out, and that's not all. Add in deductions for mortgage interest payments, which are also tax deductible, plus any expenses for repairs, property maintenance, and other related costs. And suddenly, your taxable income can shrink incredibly fast, potentially saving you thousands. That's precisely why so many wealthy individuals and families strategically invest in real estate. It's not just an investment, it's a powerful tax shelter and a reliable cash flow machine, all rolled into one. Depreciation, therefore, is a completely legal and incredibly powerful way to significantly slash your tax bill. So, if you're serious about paying less tax and building wealth, it's essential to learn how to effectively use depreciation to your advantage. The ultra-wealthy use a strategy called buy, borrow, die. Instead of selling assets and paying tax, they borrow against their investments. Stocks, real estate, even art. Loans aren't taxable, so they get cash without triggering capital gains. Their assets keep growing, and when they pass away, heirs get a step-up in basis, wiping out the deferred tax. This lets wealth pass to the next generation with minimal taxes. Borrowing against assets is a key way the rich access cash tax efficiently. It's a game-changer for building and preserving wealth. Owning a business, even a small one, opens up a world of tax deductions. Business owners can deduct expenses like home office costs, travel, equipment, and even health insurance before paying tax. These deductions aren't available to most employees. Forming an LLC or S-Corp can add even more flexibility, letting you optimize how you pay yourself and what you deduct. The key is to track legitimate business expenses and use the right structure for your situation. Business ownership is one of the most powerful tax tools available. If you want more control over your taxes, consider starting a business. As wealth grows, the rich use advanced tools like trusts, self-directed retirement accounts, and permanent life insurance. Trusts can protect assets, reduce estate taxes, and control how wealth is passed on. Self-directed IRAs and solo 401(k)s let you invest in real estate or private deals, all in a tax-advantaged wrapper. Permanent life insurance can grow cash value tax deferred and provide tax-free loans or death benefits. These strategies aren't just for billionaires. They're available to anyone willing to learn and plan. The more you grow, the more these tools matter. Smart planning means more wealth for you and your heirs. Offshore companies and accounts. The very term often conjures images of secrecy and intrigue. They sound shady, and let's be honest, sometimes they are. The world of international finance can be complex, and it's easy to see how these structures might be misused. But it's important to remember that there are perfectly legal and legitimate reasons to use them. This is especially true for international business, where navigating different legal and tax systems can be a real challenge. They can also be useful for legitimate asset protection, ensuring your hard-earned wealth is shielded from potential risks. Now, if you're a U.S. citizen, remember that you are taxed on your worldwide income, no matter where it's earned or held. So simply moving money offshore doesn't magically erase your tax obligations. It certainly doesn't make it invisible to the IRS. They have ways of finding out. Some countries offer attractive incentives like low or even zero taxes for certain types of entities and activities. This can be a legitimate tool to help with tax deferral, allowing you to postpone tax payments to a later date. And it can open doors to global investing, diversifying your portfolio across different markets. But remember, there are strict reporting rules in place, things like FBAR, the Report of Foreign Bank and Financial Accounts, and FATCA, the Foreign Account Tax Compliance Act. These regulations mean you absolutely must disclose your foreign accounts to the relevant authorities. Fail to do so, and you could face huge penalties, potentially wiping out any perceived benefit. Offshore strategies are inherently complex, requiring careful planning and execution. They absolutely require expert advice from qualified professionals who understand the intricacies of international tax law. Ultimately, these strategies are about legal structuring and optimizing your financial affairs within the bounds of the law. They are not about hiding money or evading taxes. For most of us, the key lesson is this: focus on building legal, transparent strategies that comply with all applicable regulations. Play by the rules, be upfront and honest in your dealings, and you can still benefit from legitimate tax planning and wealth-building opportunities. Strategic giving is a classic tax move for the wealthy. Donating appreciated assets, like stocks, lets you avoid capital gains tax and get a deduction for the full value. That's why you see billionaires giving away shares instead of cash. Private foundations and donor-advised funds let you control your giving, get immediate tax breaks, and support causes over time. The government rewards generosity with tax incentives. Smart philanthropy means you can do good and lower your tax bill. Give strategically and everyone wins. Ever wonder how the ultra-rich live large but report little taxable income? They borrow against assets, use business perks, and structure investments for tax-advantaged cash flow. Business owners can write off travel, cars, and even parts of their homes as legitimate expenses. Real estate and certain investments generate cash flow that's sheltered by deductions. The goal isn't to have no money, it's to have low taxable income and high net worth. The rich focus on growing wealth, not just earning a big salary. It's a different way of thinking about money and taxes. Is all this fair? That's up for debate. But these strategies are legal and written into the tax code. The system rewards investment, business, and ownership because those drive economic growth. Complaining won't change your tax bill. Learning the rules will. The wealthy use knowledge and advisors to play the game as it's designed. Financial literacy is your best tool for building wealth and keeping more of what you earn. The rules are public. Anyone can learn them. Start now, and you can use the system to your advantage. You don't need millions to start using these strategies, just knowledge and action. Focus on becoming an owner and investor, not just an earner. Every smart move compounds over time. Don't be intimidated, be motivated to learn more. Subscribe for more practical tips to cut your taxes and build wealth. Think smart, act bold, and start playing the game like the wealthy do. Thanks for watching. See you in the next one.